Why is it that your staff can walk into a bank with 2 pay slips and walk out with a home loan? But you, the owner of a profitable business, get treated like a liability. If you're self-employed and trying to borrow, you've probably already hit this wall. The paperwork, the scrutiny, the bank asking for everything short of your blood type. I'm Tommy Lim, and after 13 years of helping business owners get loans approved, I can tell you this. Most people waste months chasing the wrong paperwork, only to get rejected or worse, approved with a bad rate. In this video, I'll break down how lenders really assess self-employed income, what changes if you're in a trust or company structure, whether you're paying yourself a salary actually helps, and what your options are, even if the numbers don't look perfect. So if you're a business owner trying to get a loan approved, or you're thinking about starting a business and want to know how that might impact your ability to borrow, stick around, because once you know how the game works, you'll stop playing it blind. So we'll start by what the bank doesn't want you to know. The truth is, business owners to a bank are way riskier than PAYG clients. They view business and business owners as clients that are more likely to default and present more risk to the bank. And that's because information quality in a business can be a lot lower. Okay, so the ATO and Creditor Watch, in their surveys, 40% of small businesses in Australia exhibit poor financial record keeping. This is from the ATO and Creditor Watch. The next is paying taxes. There are simply a few more ways that a business owner and self-employed client can lower their taxes. And of course, you can't avoid tax, but they also explore legal ways to reduce tax. And as a result, there is approximately 7.6 billion in unpaid GST. This is a stat around the 2002 mark. And the overall tax gap or uncollected tax across small business generally is in the order of 17.7 billion. And so banks don't want to be seen as participating in helping people lower or avoid their tax. The final area of risk is that business itself is risky, and there is a high failure rate in starting a business. So over 3/4 of businesses do not survive past year 1. Okay, so for those that survive past year 1, it's already really good. 50% survive past year 3, 40% survive past year 5, and only 1/4 survive past year 10. And so the odds are somewhat stacked against a business owner to survive and thrive on a sustained basis. And this is something that banks know and recognize. And so if you do see a long-standing business or business owner, that's really a testament to their resilience and ability to navigate through different times and economic cycles. So even though banks perceive business as risky, at the same time, with great risk comes great reward. And the self-employed market is also a highly lucrative market for banking, as well as a whole bunch of other sectors, okay? And so there's research that shows that self-employed clients take out larger loans. So self-employed home loans are 12 to 18% higher than PAYG home loans. Next, business owners simply take out more bank products. So they take out 1.4 times more loan products than a regular customer, PAYG customer. And just banking products generally, there's 2.3 products per self-employed customer, whereas only 1.6 per PAYG customer. So a business person simply takes out more products to a bank. And finally, small business is a powerhouse and an engine room of the Australian economy. So they represent 44% of private employment in Australia and create 33% of GDP. So of course, they generate a big part of the pie, and banks recognize that they want to participate in that. and capture some of that value as well. So even though business is risky, those who get it right represent phenomenal clients to a bank, to a lender. And this is where we come in. We recognize this as well as a long-standing mortgage broking firm. So SF Capital is now in its 13th year, and we have chosen to become experts in self-employed lending. So team, the webinars you saw before on next home buying, refinancing, those were just warm-ups. What we're really strong at in our core client base is the self-employed market. And that comes in the form of three things. Home lending, everyone needs a shelter. So home lending is kind of the spearhead into the self-employed market, but also commercial property and business lending. And our three propositions to a business client are that we give them assurance, so confidence and certainty when they go for a loan, number one. Number two, access, so across types of lending, tiers of lending. And finally, high quality professional advice. So we're not salespeople, we are advisors in lending. And the goal here is to use lending in value creating ways to help them create wealth, to grow their business. We as a firm don't do any consumption-based lending, so personal loans are something we do not do. Okay, so that's a bit about us. Moving on. And this is what we'll go through today. So the first is eligibility criteria. So what is a bank looking for, specifically in the context of home lending for this webinar, when they issue a self-employed client a home loan. Number two, different entity types, just some background on that, what entities mean for borrowing. And then number three, self-employed servicing rules. So as a business owner, your income can be variable, can be volatile from year to year. What does the bank look at? How do they view that changing income? And then we are going to look at three myths and case studies with those myths. Do you really need to be in business 2 years to get a loan? I didn't pay a salary to myself. Can I still get a loan? And then finally, do loans in my business really matter? So we're going to look at those questions. And if I still don't fit, what do I do? Number one, eligibility criteria. So what does it mean to be self-employed in the first place in the eyes of a bank? This is something not everyone understands. Clients don't understand it. Junior brokers don't understand it. I would say junior bankers don't understand it. Here are some easy checks or some easy signals that show someone is going to be treated self-employed to a bank. Number one, they are the director and or shareholder of their source of income. So if there's a business paying them income and they're the director of that business, or they're a major shareholder, then this is a very big signal that they're self-employed. Number two, they bill through an Australian business number, an ABN. Okay, so to collect their income, they need to put an ABN on a letterhead or an invoice to get paid. That's number two. Related to that, number three, they directly receive the income they generate. So, a PAYG borrower or client, their income comes via a payslip, and it comes via the company employing them. Whereas as a business owner, you control the bank account that the money comes in. This is another clear sign that you're dealing with a self-employed client. But ultimately, what really defines a self-employed client in the eyes of the bank is that they control their personal income and they manage their own taxes. As soon as someone can control their income and manage their own taxes, they're not pay as you go. They have discretion around the income that they report. Of course, there's a ceiling based on their revenue and sales, but as soon as someone has discretion around the income that they can report and somewhat control the tax that they can pay, that element of change and risk already is the defining thing that makes someone self-employed in the eyes of the bank. Okay? And so it's very important to know that the bank will categorically define a client as PAYG or self-employed. Okay, so you are either PAYG or self-employed. And so being PAYG can be a subset of being self-employed, but not necessarily the other way around. Another way I like to think about it, it's not the best analogy, but let's try. Sure, you might have a reptile, a mammal, and a bird. They are distinct animals in the wild, okay? So a mammal and a bird, they are different animals, but they're different categories of animal. But occasionally you might see a platypus, okay? Yes, there might be people or customers that are blends of, they run a side hustle, plus they are employed by someone else. So you might occasionally get someone who is a blend of being self-employed and PAYG. But if these things exist, categorically, the bank will classify them typically as self-employed. Here's how I'll put it. You might be self-employed and pay yourself a salary. The bank will still class you as self-employed. However, if you're PAYG, you cannot be classified as self-employed unless you run a separate business, separate to the one that's paying you the salary. Going through case studies will make this clearer. Okay, so we covered what does it mean to be self-employed. Now we're going to go through the criteria or the ideal requirements when you're presenting yourself to the bank as a self-employed borrower. These are the ideal requirements. There are ways to relax these rules, to get exceptions to them, to be accepted without this level of rigor and information, but these are the ideal requirements. And a nice way to think about it is a tool that lenders and bankers use called the 5 C's of credit. This is something that I teach my team, the 5 C's of credit. You're going to see it here. So the first is character. This character is about not just are you a good person, bad person, but the tenure you've run your business, just like the tenure you're in a profession does matter. So a lender ideally wants to see you 2 years plus running your business. They want you to be ABN and GST registered, because if you're not, how are you legally collecting your income? Are you running a cash business? Well, then you can't really use that income to get a loan, okay? And there are thresholds where if you earn a certain level of income, you have to be GST registered. And that threshold is at a point where if you're just at that threshold, you usually can't borrow a lot of money. So anyone earning above must be GST registered. And then all normal criteria to get a loan apply. So clean credit history, lenders and banks don't like tax debt. Are you an Australian citizen or Australian permanent resident in order to get the loan? Next C is cash flow. And this talks to the documentation that the bank wants you to present in terms of your income and some of your business liabilities. So a bank usually wants to see 2 years of your business financial statements and tax returns, 2 years of your individual tax returns and the notice of assessments that come from lodging those tax returns. So we're looking at, so basically they want to see your business income, and they want to see the personal income you draw from that business. And they do want to know what liabilities also lie in the business. This is something that is somewhat of a myth, which I will address later. I'll talk about it later. And then the other C's of credit, which won't be as much of a focus in this webinar, we will talk about. So capital. Typically for home buying, 20% deposit plus cost is needed. You can come in with less, but then you need different types of deposit solutions. So paying lenders mortgage insurance, LMI waivers, looking at family guarantees. That's how to get into a property with less than 20% deposit. Collateral, they will still apply normal security rules. Is this a property that the bank wants to take a mortgage over? And then conditions. So what else are they going to request from you as a condition to approve a loan? So some banks require you to produce accountant's letters to clarify any other directorships you may hold, or accountant's letters to clarify any add backs or expenses that you want to use to alter the income that you present to the bank. So we're going to go through these things, and at the end we will talk about any comments, exceptions, learnings through the case studies that I'll present. Okay, so that's the eligibility criteria. But actually, because there's so many different types of businesses out there, and also different banking options, our role as a mortgage broker is to help you navigate the maze, okay? And so before I go into the next section, here is an example. This is why it's trickier for a self-employed client to get a loan, okay? So for a PAYG client, you show 2 payslips. It shows who your employer is, has your name, shows your year-to-date, shows your year-to-date pay. If it's a consistent salary, times by 12, times by 26, times by 52, it's pretty easy. But for a self-employed client, there's actually many more checks that you need to go through, that we go through to determine if someone is eligible as a self-employed borrower. So are they ABN registered? How long has the ABN been registered for? If you're registered less than a year, you don't even have 12 months of income to present to the bank. So this is a consideration. Is it GST? Is the business GST registered? How long has it been GST registered? How many years of financial statements can you present? How do we treat those different years in terms of assessing the income? Can we use the latest year? Do you have your financial statements and tax returns, or do you only have tax returns? What's the percentage shareholding you hold in the business? Do you pay yourself a salary? Is your income so complex that we should just look at your notices of assessments? How to treat depreciation? How to treat other add backs? What if you have other businesses and other entities that the bank can see through your credit check? What if you have loans? What if you run a business in the medical industry, or you're a doctor, allied health, or other profession? How to treat business loans? And then you have to navigate each bank and their different rules. So green in this case means it's a more friendly policy. Red, there's a policy and you may be able to pass it, but not as business friendly, okay? And so this is just across the Big Four plus Macquarie. There are way more banks. And so our role as a advisor, as a broker, is to help our clients navigate this maze of lending so they can get the smoothest loan approval and the financing that they need. Okay, part 2. We're just going to touch on entity types. So we'll look at 3 of the most common structures presented by a business client. The first is as a sole trader. So this is more of your smaller startup business, micro business. Very uncommon for established businesses or larger business owners, okay? But as a sole trader, the key thing is that the way you earn your income and you are one. You are the legal entity operating in the world, earning the income, you as a person. And so what happens there is you get the reward, but you're also personally liable for anything that goes wrong. So your legal liability sits directly with you as a sole trader. Your profits get taxed at your personal tax rate, at your personal marginal tax rate. And once you've paid your tax, the leftover money becomes your personal savings. You and the company are one. It's your savings. Once you've paid your taxes, the money left over is directly yours. What it means for lending is when you present to yourself as a bank, even though the income can change, the servicing treatment is like you are PAYG, borrowing in your personal name Once you plug the income in, the calculator works almost the same as if you are PAYG. Not for calculating your income, but for calculating the final servicing figure amount you can borrow. And importantly, if you're operating as a sole trader and you have a loan, you might still have an ABN as a sole trader. If you have a business loan, it's factored into your personal servicing. Next, there are discretionary trusts, family trusts you can set up, which then represent a separate legal person. So there is a separate entity or separate legal entity in the world operating as the business, as distinct from you, even though you run the business. Once you make a profit, that profit can be distributed to the beneficiaries of that trust, and those profits get taxed at their marginal tax rates. So you will see people, husband and wife type businesses, where this is very clean. They're going to receive the income anyway. Income gets distributed to husband and wife. But occasionally you will see income get distributed to related parties, family members, children, because they have a lower tax rate that can be utilized. The distinct thing with a trust is that it cannot hold retained earnings. So if you make a profit, pay tax, those profits must be distributed to beneficiaries. And also, if the business run in a trust makes a loss, and this is one of the limitations of using a trust, it can distribute profits, but it can't distribute losses. So losses get trapped. Losses help lower people's taxes that they pay. You can offset income with losses. However, in a trust, they get trapped. So that's a limiting factor in operating in a trust. For lending, there are some slight negatives operating in a trust. It's still, I would say, on a business sense, better than operating as a sole trader. But for borrowing, if you distribute to non-borrowers, so if you have beneficiaries that do not become part of your loan, then many lenders will remove that distributed income away from your own servicing income. So let's say you make 200,000, you choose for 100,000 of that to be distributed to a brother and sister, just hypothetically. Well, you only have 100,000, you made 200, but you distributed 100. The bank's gonna use 100,000, the remaining for loan servicing. Very hard to get that added back to your core personal income for the purposes of borrowing. Also, however, there is a benefit given it's a separate legal entity. If you have loans in that trust, there are some lenders that will exclude it and different methods to exclude those loans in a trust. Final structure, and this is the most common structure for established businesses, especially businesses that want to grow, want to scale, employ staff, have operations, is to set up a company. Okay, and so you have very small companies and you have very big companies that end up listed on the stock exchange or large private companies. And like a trust, a company is a separate legal entity, but legal liability is still correct. So yeah, separate legal liability and because it is a separate legal entity. The key thing with a company is it has its own tax rate. It has a corporate tax rate. And a lot of interest and lobbying from business all over the world for different governments goes into what is the corporate tax rate? Are we giving businesses a leg up or assistance or favorable tax environment, or are we penalizing businesses by taxing them a lot? Okay, so in Australia, that's a flat rate of 25%, unlike personal tax, which scales and has a progressive system. And then dividends get paid out from the profits. That's the difference between a company and a discretionary trust. And then you get franking credits that flow. So that means the company has already paid tax, and that tax gets reattributed to you. That tax paid gets reattributed to you, so that you'll then pay the income that you would or should have received at your own marginal tax rate with grossing up your income with the franking credit. Finally, a company can hold profits. So if a company makes a profit, it retains the earnings. So it can accumulate profits over time and build up its balance sheet and invest and grow. And if there are losses, it can be offset. Those losses can be offset. The past losses can be used to offset income, new income, to reduce the tax paid in a given financial year. So when you're self-employed and you earn your income through a company, there can be some advantage in terms of borrowing capacity, having some of your income paid at the company tax rate and retained in the company versus taking the income out personally and paying it at your personal tax rate. This sort of arbitrage or decision or rebalancing of income personal versus company is something that only business owners who run a company can use and decide on. Not all lenders realize that. There are some that do. If you keep profits in the company, it gives a slight boost to your overall borrowing capacity due to the lower tax rate. And then, like having the trust, if you've got loans, there are ways to exclude those loans with some lenders. All right, so that's entity type, questions, comments. It's just to touch on that there's different types of business owners out there. We see more complex structures than this again. So unit trusts with corporate beneficiaries, not personal beneficiaries, clients who have multiple companies, multiple trusts. All right, so we'll move on to item number 3, which is how a bank looks at self-employed income. So because income changes year to year, it can be up 1 year, down 1 year. It's not like getting a steady pay slip. And so that volatility needs to be reviewed, assessed, decided on in terms of what figure the bank can use as your reliable source of income. And so this is the basic methodology. If you've had a good year, your current year is better than your last year, then there's 3 methods. The most conservative is that they look at your last year, you've done better this year, but they only take 120% of the prior year. This is the most conservative treatment, unfavorable treatment if you're a growing business. But some lenders apply it because they're very risk averse. They might give you a really low rate, but they want to make sure that you are a really strong client. And therefore, they'll use the most conservative income that they can, even though you're growing. They'll take 120% of the previous year. A better treatment is to average the 2 years. This is much more mainstream. Your sort of mid-sized banks will average the last 2 years. And the most aggressive treatment, but it can also be a disadvantage, is there are banks out there that will just take the latest year, which really favors you if you're growing and you've had a very good year. And this is a policy offered by major banks or some smaller banks by exception. Yeah, if you're a growing business, this is the number that you want to be using to maximize your borrowing capacity. But what if you've had a bad year, or the economy is slower, your industry is experiencing a slowdown, so this year's lower than the last year? Well, this is where the latest year good and latest year bad are one. They will take your latest year because it's lower, and that will be used for your servicing income because banks are conservative. Occasionally, even if your current year is worse, there are banks that will average it. This is usually a bigger bank that will understand this or assist a client with this. But there must be some good reasons why they, even though you've had your recent years bad, they're going to average it for you. So the story of why, what your business plan is, what your business is doing, what your industry is doing, how you're performing in a current year now, even though it's incomplete. This really matters to getting an average when you've had a year that's bad. Okay, so is your current year better than the last? Then it's these rules up here. Is it worse? Then it's these rules down here. All right, moving on to the case studies and myth busting. We're going to go through 3 myths. So myth number 1, as a business owner, do I need to be a long-standing business owner to get a loan? How long do I have to be in business? So do I really need to be operating for more than 2 years before a bank will accept me for a home loan or a loan generally? In reality, it's nice. As I showed you in the opening, there's a high failure rate in business. And so ideally, yes, it's just survivorship bias. Those people who survive longer in business are typically stronger business owners and can withstand the cycles. So really, yes, it is nicer to have 2 or more years in business. But the real test is actually more of a mechanical test, which is, can you show 2 years financial statements? Which is not a length test, but a document test. Can you produce 2 years financial statements in your business, even if the first year is incomplete or weak? In some cases, you can get away with 1 year of financial statements or tax returns. And this really depends on a client's industry experience, the story behind them, their professional experience, their track record in that industry and operating a similar business. Maybe not as the owner, but as a senior manager. Or the bank recognizes that these professions are very strong. As soon as they step out on their own, they're going to make money and they're going to be very consistent in making money. And so the bank creates policies around certain professions to only use or consider 1 year. And as an alternative, if you can't show financial statements, then perhaps you are drawing a salary and that can be used as a means of proving your income. Okay, so this is myth 1, reality. Let's look at a case study. So earlier this year, we had a self-employed client who was a chippy. This is Australian slang for a carpenter. And he was a carpenter that became a timber miller. So his business is to cut up trees and make beautiful household furniture and carpentry out of cut trees in the local area. So he bought a sawmill. So that an example is one of these bad boys you see here on the right in 2022. And he started as a small business operating as a sole trader. However, he could see that his income was growing year on year and his client base was building. And so he wanted to really put some assets behind himself. And he wanted to invest $100,000, buy a property around the 600 to 650 mark, so 625. And he was happy to pay lender's mortgage insurance to get into the market. So how did we help this client? But also at the same time, how do we think about how the bank views his income? So his 24 sole trader income. So the income is, to clarify, income and profit are synonymous in this case. They're the same. I'm going to use those words interchangeably. So his revenue minus his expenses became his personal income. And in 24, that was 185,000. In 23, it was 120,000, which averages to 152. But with a 120% cap on the previous year, it's 144,000. He was renting and he had various living expenses with a young family. $580 a week was his rental income and $650 a week was his rental expense. And then if he bought a property, there'd be $380 per month roughly of property maintenance expenses. So this is how a bank would look at it. At 120% income, and remember, he wanted to buy a $600,000 property. At a cap of 120%, he could only borrow $300,000. Okay, so that's not really close to getting into a $600,000 property. At an average, it's not much better because a lot of the income is still being consumed by the costs of running a household. He doesn't have much free cash flow yet for investing in property or taking on a loan and paying back a loan. So with the average, it got to 370. But on the latest year's income, so not using these smaller figures, but using 185,000, he could borrow 620,000. And of course, this is more than he needs to buy a $600,000 property. So the loan is more than the value of the property itself. However, what if these numbers were reversed? What if what if he had a bad year and the latest year became 120 and the previous year became 185,000? Well, that's almost a complete strikeout in being able to borrow. If there was a reverse of these numbers, then he could only borrow 110,000. So this is the life cycle of a business owner. These are real experiences from a business owner. Not every year is up and up and up. And so if these numbers reverse, your current year is down, it can mean a worse borrowing outcome. And so timing does matter for a business owner in looking to take out lending when they think they don't need it. So that's another principle of ours. When you don't need the money is actually the time you should be thinking about getting the money. So how did we help this client? We lodged the application in February this year, which means he had already been trading, he had additional trading on top of these numbers of July to December. So we had last two BAS. When you annualize the sales of the two BAS, he was already earning more revenue, more sales in the FY25 year than the 24 year. So it came close to 600,000, whereas 24 sales was 400,000. And we told the bank about the client's strengths. So he was an experienced carpenter. He had the networks with builders, architects, other carpenters in his local area. And he already had bought and paid off a sawmill. So his expenses, were somewhat contained, and it was just up and up from there in terms of growing his business. And so this is one way, presenting a certain set of facts like this, and lenders who have policies like this where you can tell a story like this, gets around having 2 years trading or 2 years financial statements. Another way of getting around having 2 years financial statements and 2 years of trading is to utilize just the salary. So as a director of a company, you're using just your wages, okay? So I talked about before, there's not many platypuses out there. There's mammals and there's birds, but there's not many platypuses. And so this is not an example of a platypus. What it is the bank still acknowledges the client as self-employed. So you're a director, you're drawing a salary, you're still self-employed, but they will treat you and the income assessment as PAYG. So in other words, they will strip out the complexity of varying income. They will just use your salary, but they still class this person when they enter the bank as a self-employed client. So we'll look at how this policy works and what the advantages, disadvantages are. So I'll actually start with how it works. So firstly, there are criteria. So a lot of early brokers and new business owners think, I paid myself a salary, I therefore can just walk into the bank and show that salary and get a loan. That's not true. You only can do it under certain conditions. So some banks, the condition is, okay, sure, you're paying yourself a salary, but how long have you been in business? Is this salary going to be sustainable? Well, you're paying yourself a salary, but is this sending the business in a loss? What do the real accounts say? Is that you're paying, you got that salary, but is the business profitable? What's the consistency of the salary? Is it a real salary, or you're saying you paid yourself 100,000, or did you just pay yourself one lump sum of 100,000 and record it in one payslip? Some banks care about this. Does the rest of your income flow through different structures, and therefore there's other factors or taxes that we're not considering for you? This is something that is looked at. And what's the documentation? Like, do you have to show payslips? Do you have to show payslips? Do you have to show other sorts of more bank transactions, or even some financial statements to be eligible to just use the salary. Well, look, it's still hard. These crosses mean that these are criteria which banks care about, okay? And so NAB is one bank that recognizes this and makes it a lot easier. So in our more complex matrix I showed you, this is a stripped down version where you don't need to have a minimum trading period, you don't need to show the profitability, you don't need salary credits, and it doesn't matter how complex your structure is. They'll just look at your ATO income statement, and if the PAYG salary checks out there, then they'll still consider you self-employed, but treat you like PAYG. And so the advantages of this are, if your affairs are complex, it makes it simple. If you have multiple shareholders in the business, it doesn't matter. And if you have loans in the business, they get excluded. The disadvantages are that there is still criteria that you need to navigate to just use the salary. For a lot of clients, it needs to be thought about and planned in advance. So if someone's planning home buying, it helps talking to us earlier to help you understand how to structure this income. And the key thing is that the wages alone, if you draw a salary, have to be enough to service. So in other words, if you're taking out a wage but it's too small and you're leaving a lot of profits in the company, you still might not be able to get the loan you want, even though there's a policy available. And a case study of this is we have a client who's a very talented eye surgeon where his income was lumpy, 23 to 107,000, 24, 130,000. He went into a year of training. He worked and was treated like an intern and was paid like an intern. But afterwards, coming out of this, when he went out on his own, his income went up a lot. And to the extent that banks were willing to give him another 1.5 million of lending to help start up his business and his eye surgery with a business partner. So when he started this business, he started drawing a salary. And in 8 months, he already was able to draw 187,000. And so when you divide this by 8 times it by 12, it annualizes to 280,000. And so from here, we went from borrowing very little to being able to approve a $1.3 million loan for him. And actually, by the end of the year, the way this income checked out, he was able to borrow over $2 million, but we didn't need that. And so NAB, going back to the previous slide, because of their policy, we did not need this person to run a business for 2 years to be able to be accepted by the bank when the salary was taken. Okay, so on the top of salary, myth number 2. It's very related to the first one. I didn't pay a salary. So some clients don't even pay themselves a salary or pay a very little salary. I can't get a loan. Well, the reality is for a business owner, and I opened with this, your income consists of more than just your salary. It's actually salary plus the profits of the business, okay? And so it's more important that you run a profitable business than it is to determine what your raw salary is. The salary is not as important for a business owner. It's more about your profits. And a broker or banker that just wants to know about your salary, if you're a business owner, is the clear sign of a rookie broker or banker. A very clear sign. If you're a self-employed client and they're just asking what you paid yourself as a salary, they don't understand self-employed lending. And so this is why. Here's a very simple profit and loss. So imagine a business makes $1 million in revenue. There's 650,000 in expenses. Well, 1 million minus 650 is 350 in profit. Let's say this business owner, very rare, paid no salary. Well, then all that income is the company's income and they pay a company tax rate. Okay, so Australia's tax rate is 25%. They paid 87,500. They're left with 262,500. And their effective tax rate, so 87.5 over 350 is 25%. Let's take the other extreme. So I'll go to the other end of the spectrum first. On the other end of the spectrum, a business owner that earns 1 million and has 650 of costs can take it all out as a salary, 350. Okay? And so in here, there's no company profit, no company tax paid. It's all paid personally in a progressive scale at your marginal tax rate. And so the tax bill here is 130,638. And so in this case, you're blending out the progressive tax. That's 130 on 350 is 37%. Okay, so someone who leaves all the profits in their business is paying an effective tax rate of 25. Someone who takes it all out as a personal salary incurs a effective tax rate of if the salary is 350 of 37. And so for a business owner, it can be anywhere on this spectrum. And the bank recognizes this, and your accountant does too. And so where most business owners end up is they take out what they need for their personal requirements, for their personal living expenses, for borrowing purposes, and then they'll leave the rest of the profits in their company. Because why pay a higher tax rate up here if you can have more left over and pay a lower tax rate? So in this case, let's say they took out 150,000 of salary. Okay, so they now, instead of 130K in tax, they pay 40K in tax. So they're left in with 110. They've left 200,000 in profit. So 50K of taxes are paid. So in total, they're paying 89K of tax. Well, it's not too bad. You're pretty close to the company tax rate if this is how you're taking the income out as a business owner. And so the message is there's a sliding scale of how much income you can draw from your profits. It could be zero or it could be all of it. And this changes the tax you pay. And quite frankly, if there's a choice, someone is not going to pay unnecessary amount of tax if they can avoid it. And this is important for lending. So what does this look like in terms of servicing outcomes? Well, with this, because the bank recognizes the ability to take out the income and control your personal income, a lot of clients don't understand this. The borrowing capacity turns out the same, roughly the same. Because even if you leave all the profit in the company or you leave some of it, they will treat it like you can take all of it out, and tax in the bank's calculator, they will tax you and test servicing like you took all of it out. And this is, again, because banks are conservative. Now, there are some instances where if you left it in the company, because of the lower tax rate, you can achieve a higher borrowing capacity. This is a benefit of running a company and a benefit of being a business owner in controlling your income. Okay, so NAB is one lender that recognizes this. They recognize that if you leave profits in the company, it's taxed at a lower tax rate. Therefore, you have more cash flow left over. Therefore, more cash flow means more borrowing capacity. Okay, but the typical treatment is to treat all the income as if it's your own, and therefore tax all of it as if it's personal income, and the borrowing capacity that arises is as if you took all of it out. There are some practice notes here. This sort of treatment that I went through assumes you control 100% of the business, so it's your business. And there would be other add backs that apply. Okay, so interest depreciation. I haven't gone through that. That will be a future webinar. So this is a good thing for business owners that you can, to some extent, control the tax you pay. However, the good comes with the bad in terms of looking at it from servicing. And so this is the final myth we'll go through. And this is the myth that I've got loans in my business. The business is a separate legal entity. It's a discretionary trust, family trust, or it's a company. And because the loans are in my business, they don't affect my borrowing capacity. They don't change how much I can borrow. Well, this couldn't be further from the truth from most banks. The good must come with the bad. So because you control the business, especially if you're 100% owner of the business, even if you're 50%, whatever it might be, if you're a substantial shareholder of the business, well, it's the business's liability legally, yes, but you own the business. Therefore, it's ultimately your liability. And if you look at the documentation, you personally would be guaranteeing that loan at a personal level, even if the business is the legal borrower. And importantly, a lot of clients don't recognize this. Yes, the loan might be in your business, but if that repayment that you make on that loan affects your overall cash flow. I'll show you an example. And so most banks, because they recognize this, will factor in business loans in someone's personal borrowing capacity. However, there are some banks that will exclude it as well, which we'll go through. So let's change the P&L a little bit, all right? So before I showed you a P&L, someone made $1 million in sales. That's not what they took home, it's the sales. They paid themselves $150,000 and they left $200,000 profit in the company. Let's now assume of the $650,000 expenses, this person had a commercial property. Okay, so they have a commercial property in the business, the warehouse, an office, a small retail shop, where the loan is $400,000, interest rate of 6.5%, and the loan term is 20 years. So 20 times 12 is 240 loan repayments. Well, what happens, and those who appreciate accounting will understand this, just some financial maths, you can ask Excel, use AI, whatever you want. From these inputs, the loan repayment is 2,982. That's the total loan repayment. And of course, you make this repayment and the loan reduces. But what happens is in your financial statement, only the interest is being recorded in the P&L. However, it's a principal and interest loan repayment. Therefore, over time, even though only the interest is being recorded, the principal is coming out of your cash flow. And you don't see this in a profit and loss statement, you will only see this in a cash flow statement, which not many accountants provide for small business. And so, even though there might be some expense recognized in a P&L, the true cash flow impact must also deduct the principal, okay? And so we go back to here, you will be paying in the first 12 months, 25 grand of interest, okay? That will be part of your expenses and have a profit, you'll pay your tax, okay? So your net profit after tax is 150,000, but actually you are also paying principal in the first 12 months. Sorry, this is a really small number, but in the first 12 months, on top of that 25K of interest, you're also paying 10K of principal. And so your true net cash flow after you've paid your tax must also take out this principal and you end up with 139,000, okay? In the business, this is the business's cash flow, okay? And so banks recognize this, you should too. Your true cash flow reflects the interest and principal you pay, and therefore you are left over with less money for servicing, and that's why banks will factor in business liabilities into your personal loan servicing. Okay, so a simple rule to think about is if in loan servicing you touch the business's profits, you use the business's profits for your personal loan servicing, then the good must come with the bad. The loans in the business also must be factored into your personal servicing. Okay, so loans in the business ultimately will affect your borrowing capacity for most banks, and you can't hide it. There are checks the bank can do, there are credit checks, number one, but actually a savvy person who can read financial statements and very trained credit officers will be able to see those loans in the company balance sheet, especially if they've been there for more than one financial year. So it will get detected, you will get a question, and an inexperienced broker or banker will deal with it after a loan submitted, someone experienced knows to assess it, incorporate it, and present it up front. Okay, so let's look at the impact of different types of loans. Okay, so let's assume the same P&L, 200K, they paid 200K profit, 150K of salary was drawn in addition to the 200K profit, 7.5K of living expenses. Let's see what happens so this borrowing capacity looks all the same, okay? Let's see what happens when they introduce a business credit card. So we lost about 150,000 of borrowing capacity, introducing a 30K business credit card. Let's not worry about the credit card. What if they have asset finance? They borrowed for a car or truck, 60,000 with an 8% interest rate, a 30% balloon or 30% residual. So the repayment's about $1,000 a month. Well, yeah, it's about the same. They've lost about 180,000 in borrowing capacity, factoring the asset finance. What if we bring in that commercial property? Of course, that we talked about before. Of course, that's a larger loan repayment. So that repayment, if you remember, was 2,982. And you see a much, not because it's a commercial property per se, but because of the loan repayment is bigger, you see a much bigger hit in borrowing capacity across different lenders. And of course, you can see the borrowing capacities start diverging because different lenders have different policies in the way they treat different types of loans. And of course, if you put it all together and you have all these loans in your business, and this is very normal for a business to have these different types of financing, you can see we went from 1.3 million to 240 with ANZ. Westpac 1.3 to 480. You can see that the combination of business financing can hurt someone's personal borrowing capacity. We did see one lender not change, which I will talk about in a second. And so if you're a business that has taken up financing in your business, it will impact your personal borrowing capacity, and you need a broker, banker, financier who can navigate different lenders so that you're still getting the outcome you want, okay? And so to wrap it up, we're gonna go back to our chippy. Well, guess what? The chippy did have a loan in there. He had an excavator. The loan was about 95,000. And that actually was a big loan repayment. So it ended up being almost $3,000 a month. And with that borrowing capacity, so you saw in the latest year it was 600K. Okay. Well, you introduce this business loan and your borrowing capacity gets destroyed. Therefore, you need to find a bank that, by their policy, not by trying to hide it or not disclosing it or hoping for the best that they won't detect it, you need to find a bank up front that has a policy that can exclude business loans for a business owner. And we know as an experienced brokerage that Macquarie has such a policy, and that's where we took him, and therefore his borrowing capacity remained unaffected at 620. Okay, so something to watch. This is how we help this client. And there are some things to navigate with Macquarie itself. So the good comes with the bad. They'll exclude the business loan, but not give you the interest add back. That makes sense. They cap forms of depreciation. That's fine. We still got what we wanted for this client. And I mentioned it before, back to our surgeon. He did have loans in his business, okay? Doctors get substantial financing. They are one of the industries that banks really like, even if they're an early business, and he had substantial financing in the business. However, so if we factored all these loans and he had a business partner, so we're halving them here, he could not borrow anything more. If we factored in all the loan repayments, he could not borrow. But using that director's wages policy, we were just taking his salary Therefore, we could exclude the business loan. So we didn't look at the profits. We did not attribute any profits from his business to servicing. Because of that treatment, we could also exclude the business loans, and that is a policy from NAB. So there's, by default, a bank will look at business loans and servicing, but if you know which banks offer different exceptions, then there are ways by policy, by rules, to exclude the business loans. Okay, so finally, what if you don't fit? These are bank rules. There are clients that still don't fit. Okay, banks have criteria, and many clients still don't fit that criteria. Well, I'm going to talk a lot more about this in a future webinar, but just to give a taste and make this webinar complete, there are other lenders out there that are not banks. So they're established, very credible lenders, listed companies that help people who fit outside the box. So these are non-bank lenders that you may or may not have heard of: Latrobe, Liberty, Think Tank, Pepper, MA Money, Resimac. This is the universe of lenders that help clients who do not fit. And so the way to think about them is they do charge a higher rate and have potentially fees, establishment fees, upfront fees, risk fees coming into the loan. So they do charge for the service, but they are a solution, especially for a growth client where their financials just have not caught up yet to where they are. But broader than that, they help clients who have more cash-intensive businesses. Their accountants have lowered their taxes, but they still want to borrow a larger amount than, legally lowered their taxes, by the way, but they want to borrow a larger amount than what their profits show. They just don't fit policy. Like, they're just very complex clients. And this is a growing segment of the market. And so these are known as specialist lenders and alt-doc lenders. And why they're called that is because they offer alternatives if you do not fit. So you can validate your income via your business activity statement, via your bank statements, or via accountant's letters and accountant's declarations. So I will go into the application of this in future webinars, but these are alternative methods of getting a loan if you are a business owner and not fitting the bank. And so wrapping it up, we opened with the ideal requirements: 2 years in business, 2 years financial statements, very standard. But we learned that even 1 year can be used for certain professions, where a salary is paid and structured in the right way and you tick certain boxes, where someone has the right story and the right continuity in a professional industry. We will look more into this in a future webinar, whether you need all this documentation or some lenders only require just tax returns, or even, as I mentioned, an ATO income statement. And we'll also look later that not all lenders need you to lodge the financial statements to get the loan. So FY25 just finished. We're in July, 30 June was just a few weeks back. If you have your accounts ready and the accountant prepared accounts, there are ways to get the loan. Usually a lender and a bank will factor in your business liabilities. However, we saw some lenders can exclude. And if you're not fitting, there are specialist and alt-doc loans to help you. So that's it, guys. That's the introduction into self-employed lending. That's the one-on-one. It gets more advanced and complicated, okay? So I'm gonna save that for a future webinar. But even to the SF Capital team, hey, I really wanted to lay the groundwork and the foundation again so that we could build on top and tackle harder scenarios and embrace those harder scenarios. Okay, any questions?
Tommy, maybe just one question from
Yeah,
me.
please, Stephen.
Are all of the I guess are all of the scenarios that you've talked about in this webinar, like I'm assuming they're home loans as in secured against your home, and And are the loans always in your personal name?
The short answer is no. The loans are not always in your personal name in these examples. The principles still hold, like averaging your income versus taking the latest year, taking the lowest year. Most of what I'm talking about is in the context of secured lending and is in the context of home buying, so residential mortgages. However, a lot of the way that a loan is assessed is the same. So whether you're buying a commercial property or a home loan or taking out a business loan, a bank lender will still want this level of documentation and will want to know about you to this extent across what we call the 5 C's of credit. Where it gets relaxed is different asset types. So if you're borrowing $1 million for a specialized piece of equipment, a bank's going to want to see all this. $1 million is a lot of money. And as we mentioned, hey, it can go bad. But if you're buying a $30,000 car to just run around and do deliveries, well, the criteria is going to be a lot less. Even one BAS and proof you own a property is sufficient to get a car loan, for example. But I am mainly talking about this in the context of secured lending, property-backed lending, whether it be residential or commercial. There is one way to think about where it's different. So if your company gets so big that it can stand on its own, irrespective of you as a business owner, so you can basically swap you out or you can retire, and the company is so substantial it can run itself, then this holistic assessment of what your loans are or what your personal commitments are doesn't matter anymore. You're in the corporate part of the bank at that point. But in small business banking, yes, let's call it loans under 30 million for argument's sake. Personal guarantees, directors' guarantees, knowing to some extent what your assets and liabilities are. They're probably not caring what your income, personal commitments are at kind of the 10 mil borrowing mark. Some lenders just start not worrying about it. You're like baby corporate at that point. But small business, yes, it's almost like you and the business are one.
Yeah, okay, understand. Okay.
Happy to answer any, you can give me a call after if you have specific questions about your scenario. Happy to answer them.
Okay, yeah. No, that's been very helpful, Tommy. Thank you.
Okay, cool, everyone. All right, thank you. If you got something out of that one, then wait for 102. So at SF Capital, this is what our junior brokers do, just to give some context. Yeah, it gets more complicated, and with that comes the skill set.